The world is now more in debt than at any point in human history. $315 trillion. Governments, corporations, and individuals collectively owe a sum that is more than 3 times the entire global economy. Every year, 10% of everything the planet produces goes just to paying interest on that debt, not paying down the principal. Just interest. And here's what nobody is talking about. That debt isn't going to get repaid. It can't be repaid. The system is designed so it never gets repaid. But the interest payments keep flowing, from workers to creditors, from poor countries to rich countries, from the bottom to the top, forever. It is the largest, most sophisticated wealth transfer mechanism ever devised. For decades, governments and central banks have operated on a simple principle. When the economy slows down, inject money, lower interest rates, print currency, bail out banks, do whatever it takes to prevent pain. And it worked. Sort of, we avoided deep recessions. We kept asset prices high. We prevented mass unemployment. We kicked the can down the road. But we never did the opposite. We never took our foot off the accelerator during good times. We never allowed the system to cleanse itself. We never let bad businesses fail. We never cleared out the deadwood. The result is a forest choked with decay, an economy propped up by $315 trillion in debt, addicted to the drug of cheap money, and kept alive by legions of zombie companies that should have died years ago. Now we're facing something different. A recession that might be unavoidable. Trade wars. Actual wars. Interest rates that can't be cut because inflation is still elevated. And a debt pile so large that even a small economic contraction could trigger cascading defaults. Some economists are saying this is the recession we need to have, that it will clear out inefficiency and reallocate resources to productive areas. But here's the problem. This isn't a controlled burn to clear dead brush. This is a forest fire, started by 50 years of reckless policy with no plan to contain it. Let me show you why $315 trillion in debt means the next recession won't be a correction. It will be a catastrophe. To understand why this debt matters, you need to understand what recessions are supposed to do. Because not all recessions are the same. There are 2 types of shocks that cause recessions: supply shocks and demand shocks. Supply shocks are easy to understand. Something physically prevents production. A pandemic shuts down factories. A war disrupts shipping. A natural disaster destroys infrastructure. We have less stuff because something stopped us from making stuff. Demand shocks are weirder. Nothing physically prevents production. Factories are operational. Workers are available. Supply chains function. But people stop buying. Businesses stop investing. Everyone holds on to money because they're scared. And because businesses can't sell what they make, they stop making things. They lay off workers. Those workers have less money to spend. So other businesses see their sales decline. More layoffs. The cycle feeds itself. This is what happened in 2008. Nothing physically broke. But confidence collapsed. Credit markets froze. And the economy contracted, even though we had the capacity to produce more. Here's the thing about demand-driven recessions. They serve a purpose. A brutal, painful purpose, but a purpose nonetheless. They clear out businesses that shouldn't exist. The dot-com crash in 2001 is a perfect example. In the late 1990s, any company with a website could raise millions. Pets.com. Webvan. Dozens of businesses with no revenue, no profits, and no realistic path to either. Just hype and investor money. When the bubble burst, these companies died, quickly. And that was painful. People lost jobs, investors lost billions. But the resources those companies were consuming, the capital, the talent, the attention, got reallocated to companies that actually built sustainable businesses. The crash cleared the dead wood, and the economy grew back stronger. But after the 2008 financial crisis, something changed. The central banks decided they would never allow that kind of pain again. They made a pact to abolish the business cycle itself. They intervened, aggressively. They didn't just bail out the banks. They effectively bailed out the entire system. They kept interest rates at zero for a decade. They printed trillions of dollars. They did not allow the natural correction. They refused to let the dead wood burn. And that's where the problem started. By preventing the short-term pain of a cleansing recession, they created a long-term systemic disease. They taught an entire generation of investors a dangerous lesson, that risk has no consequences, that the central banks will always be there to bail you out. This is called moral hazard, and it created the everything bubble. Every asset, stocks, bonds, real estate, became inflated by a tsunami of cheap money. And the zombie companies that should have died in 2008 didn't just survive. They multiplied. These zombies are a cancer on the economy. They don't have enough profit to invest in new technology or expand. They just have enough cash flow to pay the interest on their existing debt, lurching from one loan to the next to stay alive. They tie up capital, they hoard labor, and they prevent new, innovative companies from growing. The dead wood is now so thick that the healthy saplings can no longer reach the sunlight. And the debt is the weight that is dragging down the economy. And it's getting heavier. Now let's talk about what's happening right now, because the bill for a decade of artificial life support is coming due. It's called the refinancing wall. Trillions of dollars in corporate and government debt that was issued at near zero interest rates over the last decade is now maturing. This debt must be refinanced, but it has to be refinanced at today's much higher interest rates. Imagine a company that could easily afford the payments on a $100 million loan at 2% interest. Now they must roll that debt over at 7%. Their interest payments more than triple overnight. The math breaks. A company that was profitable at low rates goes bankrupt at high rates. A government that could service its debt now faces a fiscal crisis. This is the ticking time bomb, and it's why this recession will be different. The tools that worked in 2008 and 2020 don't work anymore. In 2008, interest rates were 5%. The Fed could cut to zero. That provided massive stimulus. In 2020, rates were already low, but the Fed could still print $4 trillion. But now, rates are around 5%. If they cut to zero again, they risked reigniting the very inflation that required painful rate hikes to control. If they don't cut, the refinancing wall hits, and the economy crashes harder under the weight of defaults. There is no good option. The government is trapped. And here's the darkest possibility. What if they don't act? What if they are forced to let this recession run its course? It wouldn't just be a recession. It would be a debt deflation spiral. Asset prices would collapse. The value of the collateral backing the $315 trillion in debt would evaporate. This would trigger a wave of defaults so massive it would make 2008 look like a minor correction. Unemployment would spike to 20%. Millions of foreclosures, mass business failures, a decade of global stagnation. The human cost would be catastrophic. An entire generation economically destroyed. The social fabric torn apart. A recession this deep could trigger geopolitical conflict. The Great Depression of the 1930s led directly to World War II. We are already seeing wars in Ukraine and the Middle East. A global depression would pour gasoline on those fires. This is why the debt matters. It takes away our options. It turns a manageable downturn into a systemic crisis. It makes the entire global system fragile. We built this system over decades by refusing to allow natural corrections. We chose to delay the pain, and in doing so, we guaranteed that the eventual cost would be 1,000 times greater. And now we are paying the price. The recession is coming. The only question is how bad it gets and whether we have any ability to stop it. $315 trillion says we don't. If you are ready to continue decoding the financial myths that shape our world, subscribe to Economythics and click the notification bell.